Hello and welcome to the first episode of 2023 for Spy Trader Now. I am your host. My name is Ken, and let's get into this week's action starting the year off of 2023. We did one trade during the week, which was a cash secured put, and I'll show you the details of that in a second. And our portfolio increased slightly by $365.80. We have a starting capital of $100,000. We start the year off with $100,000 and we build from there. So the portfolio return right now, year to date, is up 0.37%, and the SPY buy and hold portfolio is up 1.48%. We'll go into great detail to show you that trading that took place during the week and where the SPY made the money. We do a 3-position portfolio here with Spy Trader Now. We either have shares of the S&P 500, and we purchase the ETF, which is the electronically traded fund, which is just like a mutual fund of the S&P 500, known as SPY, SPY, and that's why we call it Spy Trader Now. Or we do options, SPY options. We do both calls and puts, or we are in cash. Currently, the portfolio is 100% in cash, and that's you can see our portfolio allocation right here. So in 2023, Spy Trader Now trades is up 0.37% year to date as of 1/7/23, and there have been one round trip. It really wasn't a round trip because there wasn't we were not exercised on our cash secured put. We just placed the trade, and because the SPY is trading at greater than our strike price, we never got exercised, so we never had to buy shares. The SPY buy and hold investor is up 1.48%. Let's move on. Okay, so at Spy Trader Now, we are not buy and hold investors. We buy, sell, and trade the S&P 500. And again, here's our year-to-date results. This is a one-year chart of the S&P 500, and we'll go into the charts in great detail. Here you can see my trades. I did one trade here at this candle and one trade here at this candle right there, which was a cash secured put trade, and I'll show you the trades on the next page. What we try to do here is beat the returns of the S&P 500, and we try to put more of this green in your wallet. All right, so here is the weekly chart. This is a weekly chart of the S&P 500. And for the week, the S&P 500 gained 1.48%. Each one of these candlesticks represents 1 week's worth of data. And this one to the far right, this is called the thumbnail. This is the body of the chart. But in the thumbnail, you can see it blown up a little bit better. So here you can see the week's action. So the week opened here at the lower body, then there was a tail, and then you have the wick is at the top, and the top right here on this clear candle is where we closed for the week at 388.08 on the S&P 500. And we'll look at this in greater detail as we look through the weekly chart later on in the presentation. Okay, so here's the trade that we made on 1/3/23. We did a cash secured put with 75% of the portfolio, and the strike price was $375 with an expiration date of 1/6/23. So with that, we were able to pocket $365.80. So this is our returns and how we're going to keep track of each of our trades and see how well we do up against the S&P 500. You can go to my website, spytradernow.com, where you can sign up for real-time trade alerts. So every time I place a trade, you'll receive a text message as well as an email. You can go to Spy Trader Now as well to see my past trades history going back 3 years. If you haven't done so already, please go ahead and hit that subscribe button and hit that bell to be notified when I present a new video, and please do me a solid and give me a thumbs up to help promote this video. Thank you. All right, so here we're going to start we always want to track to see our portfolio performance on a year-to-date graph. This is 2023. We're only into this for 1 week, and here's how well Spy Trader Now did. This is how well the SPY buy and hold investor did, and this is a percentage basis of how the two strategies look on a side-by-side comparison. Now our goal, which is in the blue, we are trying to beat the pink, which is the SPY buy and hold investor. But last week, the SPY buy and hold investor, those returns turned out to be better than our returns. But it's only 1 week of trading history and we have a whole year here, so let's see how the year develops. Now, what happened on Friday? What happened to create the big jump on the S&P 500? What happened was, now this particular report by Patty Dahm, which was put out by CNBC, this report was put out on Thursday, August 5th, and I love the title of this particular article. Friday's job report is a wild card. See, this is the problem. The problem is that going into Friday, we did not know how the market was going to react. There was no way to understand this, and this was going to have a detrimental effect on the stock market, because right now, determining what happens with the jobs report, which is a critical report for the Fed, will determine what happens with the stock market. So what happened with that jobs report? The actual jobs report added 223,000 jobs, which the unemployment rate fell back. Now, mind you, we added 223, we're expecting 200, so we got more jobs than we were expecting. And the unemployment rate fell back to a record low of 3.5%, which was revised from 3.6%. This is not good considering the Fed's stance. I mean, it's good for the country, but it's not good for the Fed's stance on interest rate rising. And from this report, you would think that the Fed would want to be more aggressive or hawkish on raising interest rates. But the market took this data and it digested it, and it was bullish on Friday. So irregardless of how we interpret the data, this actually doesn't matter. What matters is how the stock market interprets the data. And the stock market interpreted this data as a good sign for stocks because they were very bullish on Friday. We'll look at the charts later on in the presentation. So what the Fed wants to see. The Fed December jobs total represents the lowest monthly gains in 2 years. So from this perspective, the December jobs total was going down. The Fed does want to see less jobs because he wants to tame inflation. His goal is to tame inflation. That means that the Fed is entering 2023 looking for a considerable softer and looser labor market because there's less jobs gains in the last 2 years. And according to Joe Brusales, which is a chief economist for RSM US, this is about the best report one could hope for given a still very hot U.S. labor market. According to Joe, this was a good market and a good report. And according to the market took it favorably as well. So here's the Fed. That's Jerome Powell. He's the Fed chair. So this is the top guy to determine interest rates. Our last interest rate hike was done on December 15th, and we are now in a range of 4.25 to 4.5. There's an expectation by Forbes that in 2023 we're going to be in the 5 to 5.5 range, which means we have another percentage rate to go. This is the calendar for the FOMC meetings dates, and the next one is on January 31st and February 1st. There's an expectation that Jerome Powell is going to raise interest rates probably by 25 to 50 basis points on this meeting. Now, here is a negative aspect for the stock market. It's an inverted yield curve. We get this from bankrate.com. So on 1/7/23, and this was updated by bankrate.com on 1/4/23, this is where we currently stand. The 10-year interest rates are at a lower rate than the 91, the 3-month, and the 2-year. This is what's called an inverted yield curve. So we have an inverted yield curve. This is a precursor to a recession. So generally speaking, every time you have an inverted yield curve, the economy is going to experience a recession probably in the next 12 months in calendar year 2023. Another thing that's bad is that we have a rising interest rate in market. When it comes to the stock market and investing, we would prefer to have a declining interest rate market, but we are in a rising interest rate market and we have an inverted yield curve. This is very bearish, a very bearish stance for the stock market. We are currently in the month of January. So in January, for a month, we are up 1.48% for the month. Now, this is the seasonality chart of the S&P 500. Going back 20 years, for the month of January, when I pulled up the report this yesterday, it said that there was a 50% chance, which means that there's a 50% chance of the months in which SPY closed higher than it opened from 2004 to 2023. So this means that the market can go 50-50. This is a completely neutral stance from a seasonality perspective of where we're going to trade this whole month. Now we are looking at a long-term view of the S&P 500. This is a monthly chart of the S&P 500 going back a long time. I'm not sure, I think it's going since 2003, okay? Now, as of late, you can see where we are in this declining trading range, and we're at the upper end, which is a resistance line to this declining trading range. The MACD is showing that it wants to go up, meaning that we've potentially reached a bottom, and the slow stochastics has reached a bottom, but you can see, especially in the thumbnail, where it's topped and it's starting to curl over. So this could easily come back down if the market was to soften at this point in time. And we are at this longer term resistance line. But if we were to break above that, it could potentially be smooth sailing for going up, but we're not there yet. Long-term stance, monthly standpoint, it's a neutral stance from my perspective. Now here is a weekly stance. Okay, so you can see that declining megaphone pattern that we're in. We are right there on, you can see it right here in the thumbnail really well. This is the trading range, the trading action from the last week's action. But we are at what's called the 390 resistance level. I have established 390 as a solid resistance stance for the S&P 500. So it's going to take some effort for it to get above that 390 level. But it's poised to do so. You can see here in the MACD where the black line, which was poised to come down and cross below the signal line, has stopped and has changed direction and is even gaining distance between the signal line and the MACD line. Well, if the MACD, if the S&P 500 can get above this 390 level, and this MACD was to not cross below its signal line and go upward, that is bullish. Very, that would be a bullish indication that stocks are going to go higher. And from the MACD's perspective, we're in this, because we're below the zero line, we're in a little bit of an undervalued section or area of the MACD oscillation. So this would be good, and we have room to grow for it to get up there and continue advancement. Now in the slow stochastics, we've bottomed and we've crossed, and are we above the signal line? Yes, we are. So you can see here at 61.12, it is slightly above the red signal line of 61.08. So that has already crossed positive on the slow stochastics. So I know the market wants to go higher, so I've put this down as a neutral to bullish stance on an intermediate time frame, which is the weekly time frame. Let's go down to the daily time frame. So now we're going to a short-term time perspective. You can see the last 5 trading days, especially here in the thumbnail. And on Friday, all the advancement took place on Friday, which the market was up 2.29% on Friday. So the advancement for the entire week really took place on Friday. Now the MACD has come down here. Let's see if it's above its signal line. Negative 2.13 compared to negative 2.12. It's very close. They're pretty much touching. It hasn't crossed above it yet, but it is very, very close to do so. It's really this 390, which I'm establishing as a resistance line, It's got to get through that, and I want to put some money to go long in this market if it does so. Now, looking at this from the VIX, or the fear index, generally speaking, the easy money to be made is when the VIX spikes up to 32, and then you want to buy the S&P 500, because then the VIX, when the VIX, this is an inverse relation to the S&P 500. When the VIX comes down, the S&P 500 goes up. So the easy money is when you have topped in the S&P 500, in the VIX, you buy the S&P 500, and then the VIX comes down and you're making money. Right now you can see that the VIX is towards the lower end of the range. So it's a little difficult in order to make money. If the VIX starts to spike and go up and you're long the market, you're long the S&P 500, you're going to lose money. So you got to be cognizant of watching this to see what it is doing. Now the VIX is acting funny. It really had sideways action for the week, but on the MACD it climbed up during the week, but it never crossed below its signal line, which is it's an interesting stance that it's taking. And I'm calling this as a neutral stance. But it looks ready to break down, which would be bullish for the S&P 500. If this MACD can cross below its signal line, come back down to tag this support line, that means that the VIX is going to smolder and molder in this below 21 range. Right now we're at 21.13. Well, if it can get below this 21 range and remain in that stance for the next week, that's going to be bullish for the S&P 500. We are on the Think or Swim trading platform on a one-year chart, same S&P 500, and we are looking at how this looks. Now this is the gold lines are what's called standard deviation, -2 and +2. Pink lines are standard deviation, -1 and +1. All 95% of all trading will take place between the -2 and +2 standard deviation. And the midpoint, which is this dashed green line, is the total midpoint of both the standard deviation lines. And we are just north of the midpoint of this channel. And so we have room to go in either direction, quite honestly. So from that perspective, it's not really telling you much. I have a couple of alerts in here. If we break the 390 level, I'm going to be alerted on my cell phone. I'm going to know that right away. And if the market goes the other way and breaks down below the 376.42 level, I'll be alerted that way too, telling me that this is a trading range. We're in this trading range. It's either going to break up or break down. But it looks like it wants to break up. I'm calling this a neutral stance because we're kind of like in the middle here. We're still in this trading range and we really haven't broken out of it yet. But even if we do break out of it, the question is how far will it go? Now this green line here, that is the 50-day moving average. And generally speaking, when you're in a bear market, which I'm considering ourselves in a bear market right now for a few different reasons. Number one, the 50 is below the 200. Number two, we're trading below the 50 and below the 200. So these things are very bearish for the stock market in general. And in a bear market, when you're trading below the 50, when you come up and hit the 50 is going to act as a resistance line. So it's gonna be like a wall that that it's hitting. It actually did hit it, tag it, and it hasn't crossed above it yet, even with that bullish day that we had on Friday. But looking at the MACD and the slow stochastics, it looks like this has enough momentum that it is going to get through that. Now let's look at this on another perspective. This is the same thing, but from, instead of going back 1 year's worth of data, we are now going back 3 months in time. So you can see that we've broken out of this downward wedge pattern that we were in. We're in a sideways trading range now. You can see that 50-day moving average and how on the wick of the candle, how we tagged it, we didn't even tag it, but we almost tagged it. Close enough that I'm going to say we tagged it. And then we came down, but very modestly. We are right there. So this is just trading below the 50. We want to get above that 50, which ironically is right at the 390 level. So this is all kind of right in the same same resistance line here that the market has to overcome. I'd like to see it get above that. So right now this chart, oh, and by the way, when you're looking at the standard deviations on the 3-month, this is a shorter term time frame compared to the 1 year. Now you'll notice in the 1 year, notice how the standard deviation lines tilt downward or negatively going from the left-hand side of the chart to the right-hand side. But in the shorter term time frame, the 3-month time frame, now you'll see how we are going north, as if the market wants to go north, which is bullish for stocks. And not only that, when you look at the standard deviations, right now we're trading very close to the -1 standard deviation. Well, 95% of all trading takes place between the +2 and -2 standard deviations. So considering that if the market was to fall, it would not have much to fall before it would tag the -2 standard deviation. So it has more room to go to the upside than it does to the downside, which is neutral to a bullish stance. And I'm leaning more towards the bullish stance on the stock market. So with all that data that I just gave you, the question is how do you play the market moving forward? So as of 1/7/23, my market summation, according to SPY Trader now, is that the market wants to go higher, but I don't want to go long until we break the 390 level and close above the 50-day moving average. This SMA is the simple moving average. And I'd like to see it for a couple of days. Then I'd like to go along with an opening position of about 25% to pyramid into a position, because I don't want to just go all in and all out. And I would like to use SPY shares instead of going with options at this point in time, because the market is so precarious right now that we're still in a bear market. We're still in a downtrending 200-day moving average. This is overall not good for the stock market. And have we reached a bottom yet? I'm not so sure that we have. Now, if we look at my chart, going on the medium time frame, which is the weekly time frame, you'll see here that I have a downside projected target of the 370 to 320 level. This good support right about here at this 320 level. So I'm thinking that this market has more room to fall, and it can very easily do so. So this is going to be 2022 was a bad year for the stock market. And I'm expecting 2023 to be pretty shaky as well. We're looking for these long bull runs, and I don't think that this market is anywhere near to looking at a long bull market run that we're going to have for 2023. So this is going to be not good for a buy and hold investor for 2023. That is, that's not our philosophy anyways. We are buy, sell, and trade investors for SPY Trader Now. Okay, that's going to wrap up this week's video for SPY Trader Now. If you have not done so, please click on like, hit that bell to be notified of new videos. Do me a solid, give me a like to help promote this video, and I wish you good trading.